Hey there, I'm Steve Balby and welcome to my Walking Mortgage Education Series. Whether you're buying your first home, moving up, or just curious about how this whole mortgage thing works, you're in the right place. Today, we're covering the basics. What is a mortgage? What are the different types? And how do payments actually break down? So let's dive in. The mortgage is simply a loan you use to buy a home. The home acts as collateral, meaning the lender has the right to take the home back if the loan isn't repaid. Most mortgages are repaid over 15 to 30 years with monthly payments, but what goes into those payments might surprise you. We'll get there in a second. So let's actually talk about those payments and what makes them up. It's usually made up of 4 different parts, often called PITI, P-I-T-I, which stands for principal, interest, taxes, and insurance. Principal, of course, is the portion that pays down your balance. Interest is what you pay the lender for loaning you the money. And taxes are simply your property taxes, often collected monthly and held in an escrow account. Insurance is your homeowner's insurance and or possibly mortgage insurance, depending on your loan. So when you make a $2,000 monthly mortgage payment, you're not just paying down your loan, you're also covering taxes and insurance. It's important to know where your money is going. So now let's talk about the major mortgage types, as each one serves a different purpose based on your situation, credit, income, and goals. So let's start off with conventional loans. These are the most common. They're not backed by the government, and they usually require higher credit scores and down payments, often anywhere from 3 to 20% or more. If you put down less than 20%, you'll likely pay private mortgage insurance, or PMI. FHA does not mean First Time Homeowner Association. These loans are backed by the Federal Housing Administration. These are great for first-time buyers or those with lower credit scores. You can put as little as 3.5% down, but you'll pay mortgage insurance for the life of the loan unless you refinance into a conventional loan later. VA loans are for eligible veterans and active duty military. Typically, no down payment is required, typically no mortgage insurance, and flexible credit guidelines. It's one of the best benefits out there for those who have served. USDA loans are available in eligible rural areas. Like VA, USDA loans require no down payment, and they offer low mortgage insurance and competitive rates. Yes, rural doesn't always mean farmland. There are some suburbs that qualify. And jumbo loans are for homes that exceed conforming loan limits, which vary by location. They often require excellent credit, strong income, and larger down payments, typically of 10 to 20% or more. Then you have adjustable rate mortgages, or ARMs. Unlike fixed rate loans, they start with a low rate for a set period, say 5 years, and then adjust annually. They're best if you don't plan to stay in the home long term, but they come with risk if rates go up. So the best mortgage depends on you, your income, goals, credit, how long you plan to live there. All of that matters. That's where a good lender comes in. We help you sort through the options, compare costs, and choose what actually makes the most sense for your life, not just what's popular online. If you found this helpful, hit that like button and subscribe for more real talk about mortgages and credit and home buying. In the next video, we'll break down your credit and how it plays into a big role of the mortgage approval and what to do if it needs work. Thanks for watching, and I'll see you on the next one. If you need to contact me here, check down below.